Oil prices have surged by nearly 2% following a significant military operation by Israel in Qatar, targeting key Hamas leaders in Doha. This aggressive move marks an escalation of Israel's ongoing military initiatives throughout the Middle East, raising both geopolitical tensions and concerns over energy supplies. Qatar, recognized globally as a major exporter of energy, promptly condemned the Israeli assault, labeling it as cowardly, a statement that highlights the fragile nature of diplomatic relations in the region. In the wake of this event, Brent crude futures experienced an increase of $1.18, representing a 1.8% rise, bringing the price to $67.20 per barrel by 10:33 a.m. Eastern Time. Similarly, U.S. West Texas Intermediate WTI crude futures followed suit, climbing by $1.14, or 1.8%, to reach $63.40. These price movements were already buoyed by the recent OPEC Plus output increase, being less than what many market participants had anticipated. Additionally, there's a growing consensus that China will continue its strategic oil stockpiling, along with worries about potential new sanctions against Russia. Traders are also keenly awaiting the upcoming U.S. weekly inventory reports set to be released on Wednesday, alongside the monthly assessments from OPEC and the International Energy Agency that are expected by Thursday, as noted by Ritterbusch and Associates. There is speculation about increased sanctions on Russia, particularly in light of a recent massive air assault it conducted on Ukraine, which had devastating impacts, such as igniting a government building in Kyiv. U.S. President Donald Trump has hinted at entering a phase of further restrictions, which, if implemented, would likely constrict Russia's oil supply to international markets, thereby potentially driving oil prices even higher. In addition, attention is focused on the forthcoming U.S. Federal Reserve meeting, which is scheduled for next week. There is a widespread expectation that the Fed might choose to lower interest rates. A reduction in rates typically results in decreased borrowing costs for consumers, which can invigorate economic growth and elevate demand for oil. Both commodities and equities are anticipated to closely follow the Federal Reserve's policy decision during its meeting on September 16th and 17th, particularly given last week's disappointing jobs report, which has many analysts forecasting a rate cut, commented Alex Hodes, an analyst with StoneX. This roller coaster of events presents multiple opportunities for discussion. What are the broader implications of such geopolitical tensions on global oil supply? How might future sanctions reshape the energy landscape? We invite you to share your thoughts and join the conversation.